Last time we spoke, we were reviewing Q2 corporate earnings in the July timeframe, and consistent with what we've seen over the past couple of quarters, earnings continued to be pretty good. Not great, but pretty good, and I think that's a fair assessment of the overall economy. If you look at employment and the high-level data for the U.S. economy in 2013, it's been chugging along at a decent pace, not really good enough, if you ask me, given what the stimulative measures that we've seen through the Fed. But if you look at the market returns, the market is telling us that the numbers are good enough. Well, it's telling us two things. The numbers are good enough, and also the market is comfortable that the Fed is going to have our back as investors. Today is Fed Day, so Ben Bernanke is on the Hill talking about kind of the latest and greatest with Federal Reserve policy. And the Fed and Ben Bernanke actually, I think, surprised the market today by communicating that they will not be tapering Fed purchases in the near future. So the Fed is essentially letting the market know that they are going to continue to be very aggressive in buying fixed income, keeping rates low for the foreseeable future. And that's probably, in terms of low rates, that's going out for a couple of years at least. And in terms of the bond buying, there's no real guidance on that, but for the foreseeable future as well, the Fed will be buying bonds out on the yield curve to keep rates low for, let's say, 10-year, 15-year, and 20-year maturities. And that's a surprise to the market, and the stock market is receiving that very favorably. Stocks are up. Bonds are also up on that news, as there really was an expectation that the Fed would be reducing their bond buying, which means less demand for bonds, and that had caused bonds to sell off a little bit. But now that the Fed is fully committed to buying bonds, bond prices are up and rates are down. And this is somewhat topical because if we, here in the office we have CNBC playing in the background, and I know a lot of investors and clients listen to CNBC or have it on in the background as well. And it's a source for financial news. And over the past few years, I think we've gone from the news media has gone from crisis to crisis. If it bleeds, it leads is kind of the way that the media works, and in the financial world, that's been quite harmful. So if you think back over the past few years, there's been a lot of things that, quote unquote, we are concerned with, and CNBC really plays that stuff up. So whether I got a laundry list here of things, and these go back over a period of 1 to 2 to 3 years, but sequestration, the taper from today, Obamacare, the debt ceiling, what's going on in Egypt, U.S. elections, Syria, Chinese GDP, and the fact that it's been slowing, high-frequency trading, the Greek exit from the euro, or the potential Greek exit from the euro, Larry Summers at the Fed, low volume. This isn't even really a full list of things that the media has tried to convince us of as being big and scary for the market, but it's a pretty good list of things that the media has focused on over the past few years. And my takeaway from things like this and what the markets have done over the past couple of years in the face of this is that what we really need to do as investors, whether it's us here at St. Germain focusing on what to buy for a portfolio, or it's for an investor in their 401k plan, that is to really do what we always say as financial planners, and that is have a long-term strategy based on your risk tolerance, based on your age. Do periodic investing through your 401k plan at work or through some other dollar cost averaging strategy. Focus on the important things like, are the companies that you invest in good shape? Are their earnings okay? And maintain that asset mix through the ups and downs of the market. And history tells us that if you do that, things more often than not have turned out okay. So kind of distilling that to the current day, the financial media, the headlines are sensational, and they really are a distraction. And developing that long-term plan and sticking to it is the best thing that we can do at St. Germain, and is the best thing that just investors in general can do. Thank you.